Hey, Think Realty, thanks so much for joining us today on the podcast. My name is Eddie Wilson, the founder of Think Realty since 2013. As a third generation real estate investor, I wanted to bring a lot of the conversations I was having with my grandfather and my dad around the dinner table to the general marketplace. And then I bring a lot of friends and people that I invest with to the podcast as well to give you a good roadmap for success in real estate. We've got a great guest today, and we'll get to him in just a second, but I want to say a quick thank you to our podcast sponsor, which is CV3 Financial Services. When you're taking on a new real estate investment project, having a trusted lender is key. Count on CV3 for your fix and flip, rental, cash out, or rate and term refi needs. You can visit cv3financial.com/think realty, cv3financial.com/think realty. Our guest today is Dennis Cisterna. Dennis, thanks for joining us on the show today.
Absolutely. Thanks for having me, Eddie.
It's been a long time since we've caught up. I know you have moved a lot in this industry. I have as well. But I go back, probably one of the most interesting covers on the Think Realty magazine, I think belongs to you. I'm still not even sure what you're doing on the front of that. You're floating in air or something. I'm not really sure.
I think I'm balancing. I think I'm
balancing.
The title of the cover was Perfect Balance.
Got it.
I don't know why we did that. I think I just because obviously I was a reader and know you well. I was like, you know what? I think I got to do something a little different than just standing on a corner somewhere,
yeah,
looking like I'm important. So let's have a little fun.
Very good. Well, it was good. Definitely memorable. In my brain, it's always still there. So you're associated with the balancing act, I guess. So tell us just real quick by way of intro, like what you're up to today. Obviously, we see the Sentinel Net Lease behind you on the screen there. Kind of explain to us what it is and what you're up to today.
Sure. Yeah. So I've actually spent quite a bit of time in a variety of sectors, especially including the SFR sector. And I guess the easiest way to explain it is I kind of move to where the opportunity is, so I don't want to beat a dead horse where I don't think I can produce an outsized return. And so that allows me to move around to different verticals and try to have success in those fields when I think I can. I think we did really great in the BFR side of things with another entity that I own. And then we started Sentinel Net Lease in 2019. Little did we know that the COVID was going to kind of take over the universe, but our primary focus for Sentinel is on office, industrial, retail properties, and really looking for cool, mission-critical stuff, especially in this environment where people are saying, they've kind of said, e-commerce is destroying retail, work from home is destroying the office, and, those things can be true, and yet there can still be good opportunities in both of those sectors, right? Because if you look at anything in the history of U.S. industry, we evolve, we change, and we figure out how to kind of thrive. So our primary focus right now is really on buying super long-term, stabilized office, industrial, retail that are secured by net leases. That means where the majority of the responsibilities are with the tenant, and those are generally Fortune 500 companies. So those leases and the lack or the probability of default is extremely low. So it's almost kind of like buying a bond at a super high coupon. And so we're taking advantage of those elevated cap rates and that have also suppressed value down. And so we think we're in a very good spot right now where we can buy at kind of a historically good basis in the commercial real estate universe, and buy things that have really great ability to produce cash on cash returns in this environment, which is tough in any kind of income producing real estate. And so by doing that, great, we can double or triple the cash on cash return. Maybe you would get in a multifamily deal. And then still be in a very good position that when or if interest rates do come down, we either refinance or we take advantage of that cap rate compression that's going to occur at that time.
Now, do you also syndicate deals, or are you primarily doing this through some sort of a fund structure?
Yeah, so our first 20 deals we did as individual syndications, and we're doing the fund, and the fund is actually still structured very much like a syndication in that we are very focused on your average retail investor. I intentionally do not want institutional capital to come in and kind of tell me what to do. I've played that game. It's been very good for both of us, but at the end of the day, I kind of feel like I'm a glorified acquisitions guy, even if I'm running the show. So since we started Sentinel, we've really taken mom and pop, doctor, dentist kind of money, people that are looking for something different in their portfolio. And so we started the fund for a couple reasons. One, because we think we've got a runway of 2 or 3 years where we can really gobble stuff up at a really compelling basis. And two, because we wanted to expand our investor base. And as you might, as I know when you've got a good deal and you've got a nice network of investors, it's actually hard to expand that network because your investors come in and gobble up the opportunities before you have a chance to market them to anybody else. And we thought about it and said, well, let's create this $100 million fund and really spend some time marketing our platform, letting investors that don't know us know what we're all about, what our track record is, and it's been great so far. We're a month in and we've already raised $22 million out of the 100. So
that's awesome. Congrats.
I'm okay with that.
Yeah, very good. So let me just ask you more of a economics question pertaining to like what you're seeing and what you're investing in. So we know that, obviously a lot of the Think Realty listeners and viewers, they're mom and pop investors, right? A lot of them they're usually high net worth income earners or high W-2s, and they're trying to find alternative asset classes to invest in. The stock market's not yielding, their 401k is not yielding, so they're trying to put money somewhere, right? And for them, we're always teaching kind of this concept of the K wave and how the markets move, and that every 7 to 10 years, we're hitting peaks and we're hitting troughs, but the thing is I think that oftentimes we miss the fact that sometimes the marketplace is different based on the asset class, right? Like, just because SFR might be on the way up doesn't mean that office isn't on the way down, right? Like, it's not like universal is a kind of a universal, or like a real estate's a universal class and everybody's on the same ride, right? So let's talk about office for a second, because like you said, there's kind of this thought post-COVID that e-com is really going to eradicate the class A office space and it's really going to hurt it. But it doesn't necessarily seem to be the case. I mean, we've seen, some of the lull, we've seen some of the trough there, but it doesn't seem to be the place where it's staying. Are you seeing a resurgence or kind of a different look, and where does it fall on that curve?
So you made two awesome points. One, not every asset class is the same. And to take that even further, even within the asset class itself, it isn't the same. And office is a very good example of that, right? So when you're looking at the headline news of the fallout with the office sector, what you're reading about is the central business districts in Manhattan, San Francisco, Los Angeles, right? I don't know if you visited the downtowns of San Francisco and Los Angeles anytime recently. There's no reason to go there. The area is suffering from blight overall in this post-COVID fallout. It's really exacerbated homelessness, drug use, and a lack of quality of life. And so I view the office sector as two totally different universes when it comes to urban versus suburban. And we only buy suburban. And so when you do look at office as a whole, yeah, I think things have gotten blown out of proportion. We've already started to see vacancies tick down in a number of overall markets. But we've also seen a surprising amount of stickiness and resurgence in those suburban markets where, look, if you're going to be forced to go to the office, it's a heck of a lot easier to get to the office 10 minutes away in the burbs than going downtown on a train or whatever else you got to deal with.
Sure.
I think you've also seen companies already start to right size the space needs they have, because COVID did show them that not everybody needs to be in the office all the time. Yes, it's essential for building camaraderie and a workplace culture. But if you're a back office person that doesn't actually, coordinate or communicate with anybody on a daily basis, you probably can do part of that job from home. So you have companies that have now established, okay, this is what our real estate needs are today. And if our company grows, which is the goal of pretty much every company, we're going to need some more space in the future, but we've now reset what our baseline is. And so that's been an important shift over the last couple of years. And so, we look at all of the positive figures we're seeing, and then we look at the headline news, and we feel like the baby's getting thrown out with the bathwater here, where I can go buy a Class A building at $125 a square foot. It would cost me $600 a square foot to build that new.
Sure.
So I've got this great defensive barrier against any new competition. Not that anyone's building a ton of new office right now,
Right.
but if they were, or even if I'm looking at what my basis is versus people that bought pre this interest rate hike, we're in a good spot because we can lower our rental rates, we can offer concessions, and still have an extremely strong yield relative to the rest of the market.
Yeah. I know you obviously play in this commercial space. I know you also have spent a lot of time on the finance side, right? Like, and so I'm curious to know if you are talking to retail investors, which that's who our listenership and viewership is. You just talked about the opportunities in office. How about in the debt space, right? Like, to me, there's so many new vehicles coming out. There's so much Wall Street capital like forcing its way into the marketplace. If I'm a retail investor, I typically understand equity, but I don't understand debt, right? Are there opportunities right now in kind of debt finance for the retail investor?
Yeah, and I would say there's a number of good opportunities there. That's and you're right. Well, I would tell you a lot of retail investors probably struggle once you get out of single family or even multifamily investing.
Right.
But debt to them is a totally different concept. And that's kind of what blows me away in this market is like, what I would consider to be serious investors are buying assets at a 4 or 5 or 5.5 cap rate, and they're borrowing at 6.5 or 7%.
Mm-hmm.
Your lender is not willing to take the risk at a 4.5 or a 5 for half of the proceeds. Why are you going to take that risk for the rest of it?
Right.
So I think there's a tremendous runway in addition to our strategy on the debt side where you are going to get, because of where the baseline interest rates are, you're getting a very solid risk-adjusted return compared to the rest of the market. There are very few equity positions I would even consider right now outside of what we're doing. It's why I sold my entire build for rent portfolio in 2022.
Sure.
But I love the debt space, and you've got a number of great firms out there. Obviously you're pretty darn good when it comes to note buying and that entire field. But even beyond that, there's a number of platforms that let you participate in private lending or hard money loans, as some people know them, and even long-term stabilized debt or more institutional bridge debt, where you can go out and your exposure is really not that high, especially in today's environment, and you're going to be able to clip a coupon that's 8, 10, 12%.
Sure.
Now, granted, you don't have the upside of the equity, but if you're looking for what the equity looks like on some of these other asset classes, you got to thread the needle to get to that number anyway.
Right.
So you might as well go for, again, what I think is the appropriate risk-adjusted return in this market. I mean, your high yield savings account is giving you 5%. Why would you go and invest in a piece of real estate where it's going to give you less than that and you actually have real operational risk behind it?
Right. Yeah, that's a great point. In talking to a lot of real estate investors, retail investors, I constantly talk about this concept that they need to be thinking about real estate in decades, not in years. And that was the benefit of growing up in a third generation real estate home, was I got to see it play out from my grandfather, right? So like I saw the value of it over time. And I oftentimes talk to retail investors, like you're talking about, dentists, doctors, chiropractors, high net worth, white collar workers. And we talk a lot about the general marketplace. And, if they're getting 4% on their 401k, or maybe they're getting 5% in the market, we have this conversation all the time that if you're going to double your money, your investment capital, if you're going to get 4%, it's going to take you 14 and a half years to double your money. And then if you double down, another 14 and a half, you're so far off of the ability to retire at that point.
Right.
But if you get into a good real estate deal, oftentimes, especially in the commercial space, you can double your money in somewhere between 4 and 7 years, right? Like in certain instances. Well, if you double,
or even less, depending.
Right.
Like, I'll give you a good example. We bought a JP Morgan call center in 2022, right before rates went up, or as they were going up. but we bought it at $92 a foot.
Yeah.
And it was a Class A building. We sold it in January, Eddie, and our our multiple on invested capital was a 1.9, right?
Yep.
Essentially doubling your money in 23 months.
Right.
So those opportunities, those do not exist when you are not thinking about how to create value in your investment portfolio.
Right.
And if you're gonna sit and clip just a coupon, to your point, there's a lot more attractive things out there than 4 or 5% a year, and there's a lot of experienced operators out there that know how to navigate the markets appropriately to kind of get you that higher yielding coupon at a minimum, whether it's on the debt or the equity side.
Yeah. The stat says, and this is more of a global stat, is that, or at least national stat, that, the average person needs about $2.3 to $2.4 million to retire. If somebody could start with $100,000 and they could double that every 4 to 5 years, it would take them about 20 years to earn about $3 million, right? Standard math. And to me, that's why I love what you're doing, is because what you're doing is a vehicle that actually makes that possible. Like, I can speak at it from an ethereal standpoint, but then I go out and buy my own assets and I hold them. I don't like syndicate to people, right? Like, I just buy and hold and keep them forever, But like what you're doing is providing that service so that when I'm speaking to that and saying like, look, if you're in your 40s and you actually want to get to retirement, like this is a fee, and you don't have to come up with $1 million. If you could somehow set aside $100,000 and double it, literally just every 4 to 5 years, that you got $3 million sitting there. Like, that's real money that can pay a real percentage of dividend to help you get through retirement.
Honestly, I would tell you people should get started even earlier than that, right? Yeah. As soon as there are vehicles out there where you can invest as low as $5,000 or $10,000. Now, granted, and in those situations, you don't have to be an accredited investor,
right?
Because that's a big hurdle for a lot of people to get into syndications. Is, hey, I'm successful, but I'm not accredited investor successful. I got it. Well, look for what the opportunities are out there, whether they're platforms that are built to really the retail masses, even below the accredited investors.
Sure.
Or just start getting into, the universe of networks like your platform where, hey, learn about it, idea exchange, go meet people. My very first real estate deal I did on my own, I was in my 20s. I did it with my brother and one of our best friends, and none of us were accredited investors, but combined, we had enough money to tie up a property and get the ball rolling. And that's half the battle, is just getting off your ass and going and doing something and taking a chance.
Yeah. I feel like we serve the active investor well. Like, we can teach them how to wholesale a house, or we can put them in contact with somebody that's going to do a turnkey property. They can buy one and get some leverage. But I feel like what we don't do well is service the retail investor that really just needs passive income, because they're still sitting in a dentist chair, 50, 60 hours a week. They don't have time to go flip a house or wholesale a deal or even really do the research to underwrite properly. And so, I feel like what's popping up in the marketplace is, people like you that are willing to share, right? Like, you'll go make your money, but also provide a good vehicle for them. And I really encourage our audience, like, they've got to choose a path. You have to choose an active path or a passive path. If you want consistent returns, you should choose a passive path, right? Like, because if you're gonna go on this active path, like a lot of people don't want to leave their W-2 job and go, do real estate for a living. It's up and down, right? Like, I mean, it's like it's feast or famine. And so, I always say, if all you have is a little bit of time to exchange, then you better go the active route. If you have dollars to exchange, right, then it's more of a passive path, which is, what you're doing here. So, any other advice just for real estate investors that maybe are taking this passive path on what's going on in the marketplace, what asset classes they should be looking for, how to get involved?
Yeah, look, I think there's a ton of very easy to digest information when it comes to working with a syndicator or an investment manager that's going to focus on a real estate deal. Part of the problem is they can put any kind of projection they want, and unless you're really a market expert, you don't know if that's real or not. Are they going to be able to, especially in the multifamily sector, where we're seeing a lot of syndicators get absolutely crushed because hope is not an investment strategy, right? You don't know when interest rates are going to go up or down. You don't know exactly how much you can push rents by or how much occupancy is going to lift. And so when you're looking at these deals, look for if the investment manager is actually showing you other scenarios. What is the downside scenario if you don't hit your number? What does our cash on cash look like if you can't refinance in the third year, or if you don't exit at a 3.5% cap rate? You know, and that really kind of shows you if the emperor has any clothes or not, because then you say, oh, well, okay, so unless you hit A, B, C, and D, this is like a 7 IRR deal, which again, okay, might as well keep my money in my high yield savings account, right? So that's part of it, where if those syndicators cannot be transparent about their assumptions and what it looks like if you stress test those assumptions, buyer beware, in my opinion.
Yeah, it's great advice. How can they find you to find out more about the fund or what you're doing?
Sure. So they can visit sentinelopfund.com, and that's just Sentinel, as you can see right there, OPPFUND.com. That'll allow anyone to download the investment summary. It kind of talks through our strategy, our track record, all of the fund terms and everything else. And once you fill that out, someone on our team and our investor relations team will get a hold of you. And again, we're pretty open kimono on everything. So if you want to have a conversation with me, I have a lot of investor calls where even if it's a $50,000 or $100,000 check, I love, just like you, I love educating people in the space. And even if someone doesn't invest with me, that conversation might be more valuable to them long term than I really could care about on the money they invest with me anyway.
Yeah, it's awesome. Dennis, it's always good to see you. Thank you so much for coming on the show today.
Yeah, likewise. Appreciate it. Thanks.
Appreciate it. Thank you. All right. And one more quick thank you to our sponsor, which is CV3 Financial Services. When you're taking on a new real estate investment project, having a trusted lender is key. Count on CV3 for your fix and flip, rental, cash out, or rate and term refi needs. Visit cv3financial.com/think realty. That's cv3financial.com/think realty. And also, one more thing before we end the podcast. On July 31st, we actually have a brand new REI Summit that's virtual. We always do in-person events, and we've got one this year. We just had one recently in Phoenix. We have Orlando coming up. But we have the virtual summit so that everybody can nationally join and really navigate what to me is going to be a very interesting time period, which is the election cycle. I have always found it to be very beneficial to invest in the election cycle while everybody else is sitting on their hands. Did you know that the last 4 election cycles, there's been a decrease in interest rates? I don't know if that's going to happen this year or not, but we need to be prepared for what's going to happen in this election cycle and make sure we're taking advantage of the opportunity. And you can find out more about that by going to thinkrealty.com and learn more about our virtual summit coming up on July 31st. You can actually get a discount by going to the virtual summit and using the code LAUNCH. Thank you so much for joining us today on the podcast. Make sure to grab your local, buy your local Barnes & Noble and pick up the Think Realty magazine on the shelves. And we would love to talk to you soon. Have a great day.